And so it broke through the channel, and as you showed there on the chart, it's been up more than 3 days in a row, and volume's been adequate. So by my own rules, we have had a breakout. So I think it's important that, since going below 4,000 in July, we've advanced more than 10% from that low. We want confirmation on a gold breakout by silver, confirming it. It has not, as you indicated, and I agree with you. So let's say we get to that line and it breaks down. Doesn't necessarily mean that silver will break down. What it does indicate, with a high degree of probability, there's nothing 100% technical analysis, but with high probability that this is needs more consolidation, needs more work, and don't get too excited.
You're watching CapitalCosm. My name is Danny. It is August 11th, 2026, and my guest today is David Morgan from the Morgan Report. David, always a pleasure.
Well, thanks, Danny. Good to be back.
So, David, you and I have a lot of stuff to talk about, but before we do, hit the like and subscribe if you have not yet, everyone. Hype the video as well. Let's get this video out to as many people as possible, and I do appreciate the support. Let's kick it off with gold. Gold appears to be making a breakout if you are of the technical analysis bent. You see a consolidating triangle here, a descending wedge, breakout now on 1, 2, 3, 4, 5 consecutive candlesticks moving upward. But I've got to ask you, David, is this breakout for real or is it a fake out? Because sometimes they do come back and retest.
You're making me chuckle because I know I've talked about the Morgan rule on your channel before, and it's the horizontal line. I'll digress for a moment, but one of the many people I've met on my journey here in the precious metals / resource investing sector was Courtney Smith. Courtney had actually made a living trading at a very early age, and he and I teamed up for a while, did some workshops together, and he actually met the guy that invented stochastics. And
Really?
we did this workshop. So I did a lecture for half a day. Then he did the second half of that day. I think it was a 3-day event. Anyway, the point being is he convinced me that horizontal lines are more important than these channels that everybody uses. And so it broke through the channel. And as you showed there on the chart, it's been up more than 3 days in a row, and volume's been adequate. So by my own rules, we have had a breakout. So I think it's important that, since going below 4,000 in July, we've advanced more than 10% from that low. Treasury yields remain relatively high. The dollar has not completely broken down. Continued debate about whether the Federal Reserve will raise interest rates or not. And investor enthusiasm remains concentrated in technology and AI. I just spoke with one of my hedge fund buddies and a couple of the depositories and wholesalers, and things are still very quiet in the precious metals from the physical side. In fact, one retail dealer, it's not just one, but one well-known retail dealer is selling silver rounds at spot, which is good, buying them at spot, but they're also buying back at $9 under spot. So I checked with one of the main wholesalers, what do they buy back for? And that's $3.50 the ounce. So that entity is making $6 on every one that sells back to them, which kind of annoys me. We've been through that before. I don't want to be a broken record, but you got to be careful, people, on who you buy from and who you sell back to, because not all dealers treat you the same. So gold is being purchased from reasons deeper than the next Fed decision, sovereign risk, or monetary credibility. It's geopolitical uncertainty and diversification away from paper resources. China's printing faster than they have in a while, and we're seeing the Asian markets pick up with more demand.
And you also have, interestingly enough, that you said that there wasn't really much demand on the retail side. There really isn't much volume either. If you look at the volume down below, even at the breakout, there wasn't like a big spike in volume like there was back in the early part of this year and late last year. And you really saw the volume start to pick up as we rallied higher. This time around, it's pretty much been consistent. What does that mean?
Well, volume is extremely important. and it means that it's well. I'll just say what I've said on another interview 2 days ago. I am not convinced we won't see a spike low again. Now we've met my criteria for an upside breakout, but that only works about 80% of the time, which gives you a 1 in 5 chance that it's, we'll call it a fake out, maybe, or false breakout or early breakout. Don't know yet. The market knows more than me. But when it's like volume, it's not conviction. When you see those three candles that you show us going up and the volume is up and up and up, that's conviction. There's power behind it. It's sort of momentum. Being an engineer, what's momentum? Mass times velocity. If you got a big ship full of oil and you got it sailing at, I don't know, 12 knots, you can't slow it down very easily. That's momentum. And we don't have much momentum. It's not very strong. It's there. Can't argue the price, but I can argue the strength.
Well, while gold has broken out, it does not appear, at least by my counts, that silver has. Is silver potentially? I mean, are we still waiting on silver to confirm the move on the part of gold? In your view, is that
Yeah,
really when gold starts to take off?
yeah. You never, I wouldn't say studied under me or whatever. I'm not, my ego's in check, but we think a lot alike and you're really good at what you do. And I appreciate it. And that's
Thank you.
another thing that gives me pause that we might see a spike low. Why? Because I believe what Jim Dines taught me, which is the Dow Jones theory applied to the metals. You want confirmation. You want confirmation of Dow Jones Industrials by the utilities and the transports. You want confirmation on a gold breakout by silver confirming it. It has not, as you indicated. And I agree with you. So let's say we get to that line and it breaks down. Doesn't necessarily mean that silver will break down. What does indicate with a high degree of probability, there's nothing 100% in technical analysis, but with high probability that this is uh, needs more consolidation, needs more work, and don't get too excited. The August lows are typical seasonality wise. Again, seasonality is a probability, but not a fact. But we could see, again, something that surprises everyone to the downside with both the metals. And this would shake out new new buyers, especially in the paper markets. But again, time will tell. Let me just state the facts and not try to upset people because timing the markets are difficult. If you're a long-term investor or you're just buying as a hedge position or you realize the true state of the economy and what lies ahead in the next few years, and you buy gold here or silver here, and we do get a big spike low for a few days or a week or whatever, don't despair. Hold your position. Really, these metals do what they're supposed to do, and that's preserve your wealth. There are times they will make you wealthy. They can go to a highly overvalued position at times, but those are usually spike highs, and those are ones you want to sell into. You don't necessarily need to sell for cash or fiat. You can sell for real estate, a business, some in the stock market, pay off debt, whatever, but there's use for that. And so I want to be clear. If you time again, timing is difficult, but based on the technical work you do and you're good at it, I think that we do have to pause and not get ourselves too excited here. I looked at X this morning. I'm spending less and less time there, Danny, but my overall consensus based on the feeds that I subscribe to we're already too bullish and we really haven't confirmed the breakout yet.
Well, here's another piece of evidence to look at. This is the silver to gold ratio, and much like silver, it has yet to break out. Now, it has started trending upward, but it has not given that confirmation by breaking through this resistance line. Unless you would draw the line any differently than I would. Is this
No, I would
more
go up right there, right at the top of the green line, bring it down, down, down. My horizontal line. I want you
like
right
that?
there. Yeah, up a little bit to the top of the green line is right there. We need a breakout from right there. The way I work this with the
Mm.
horizontal lines, which is kind of where we're at, as you show. We got to get
Oh,
above
this.
there. So I
Mm.
want to see that go 3 days in a row on above average volume, and then I'll say, okay, we got confirmation. And we don't. We're right there at the break point. And we could go up 2 days and down. So 2 days aren't 3 days. So again, I like what you're showing everyone. And you know, again, people, I mean, this gets kind of into the nitty gritty, and I tell people don't look at the daily charts and get all excited. But you know, if you are using leverage, you got to use every tool available, even if you're not, if you want to time it. But the best thing for most people is just to take a position and average in, you know, because if you average in, you're going to take the emotion out of it. You're just going to buy $100 a month or whatever your budget allows, $1,000 a month, whatever it might be, and you can cool off and not really worry about this stuff. But since I'm not only fundamentally oriented, I'm very technically oriented. Um, Although I do not provide technical report, I do go through technical work mid month for the premium service, and I do stuff like you're showing us right now.
So just to clarify, you would utilize this horizontal line as some mechanism of resistance, and if we have 3 days above the support line,
Three
this
days in a
become resistance
row above it
in a row.
because in a row is enough data. And so you
Mm.
might be buying, let's say you're going to go on the long side, but you're waiting for the Morgan rule to take effect. So you have to wait for that third day. And it is on close only. So you should really be positioned on day 4. But let's say, all right, it's up, you know, most of the day on the third day. Well, you would be entering that market above where you are right now. Most, you know, absolutely. And well, I missed the move. I should have got in when it was touching that line. Well, that's like a 50-50 proposition. You know, it's not good use of margin or good use of money management to do it that way. You're much better buying higher with the momentum than you are trying to guess that it's going to break out.
So essentially, if you do it a countless number of times, you'd come out ahead just by waiting for the confirmed breakout.
Yeah. You leave a little bit on the table that you might have missed, but we're counting, you know, we're counting peanuts really. I mean, if this thing does break out, the next resistance is, you know, up to the top of that next peak and then at the next peak and the next peak. So, you know, you got a pretty good move, but you can see where it was support back to the left where that green line hit at the bottom and bounced up. Again, there, second time it bounced up and went really high. And the third time it broke down and now we're up. So now that support has become resistance. And that's all basic technical work. But people that aren't familiar with technical analysis, you know, they're learning something today.
So, what's your broad prognosis of the macro landscape right now, given
I'm,
the recent
yeah,
moves in metals?
I'm looking for, you know, the high 4,000s to $5,000 gold by the end of the year. I'm not looking for 5,500 again. And for silver, I'm looking for like something around 78-ish or thereabouts. I mean, a lot of my, you know, compadres think we're going to hit, you know, triple digit silver pretty easily. And, you know, $5,000, $5,500 gold's, you know, something we'll be looking in the rear view window and will be, you know, 6,000 in a year. I'm more conservative than that. I've been in this market a long time. Doesn't make me right every time. People know that. But normally these sell-offs like we've experienced, where like a 50% takedown in silver, you don't build back in a matter of a few months on those kind of takedowns. It takes longer than that at most times. Barring, you know,
Interesting.
again, the market knows something that I don't. It might, you know, could be something in the war or whatever, but no, generally speaking, and I'm not upset by that. I think we need to build a stronger base, keep the strong hands, and add to the buying pressure. And we're not seeing any adding to the buying pressure right now. The stocks are starting to move, and those are generally
Mm.
different investors than the metals investors. So the stock investors are forecasting that those earnings that are so robust that are in the mining equities and the royalty companies are going to catch the eye of, let's say, the professionals, the institutions, because that's really where you're getting strong yields based on the price earnings ratios. So they will and probably are coming in the market. It's actually safer right now to be in the equity side than it is on the metal side.
Fascinating. From the bottom of, so we've got GDX pulled up here, the gold mining ETF. And from the bottom of this consolidation to the highs that we've seen the last day or two, that's a 30% move in GDX.
Yeah.
And
And
you'll
that's what
notice
you
the
see in
move.
real strong bull markets. Sorry if I keep interrupting, but you get me excited. And you're showing the right charts at the right time. And, I see that gap. I mean, that means there's a
Mhm.
lot of momentum. It's like, holy
Yeah,
moly.
multiple gaps. There's two,
Yeah,
well,
right.
three if you count this one down, this slight
Yeah.
gap here, but two big ones here.
So it's perplexing. I mean, if you look at it from, the metals, why aren't the metals going? Why the heck are the stocks going? Well, the stocks have been underappreciated and you know, they're very undervalued. And so, I mean, Rick Rule, I think, sold off a lot of his silver. I don't know if he sold all of it or not, but he went in the equity side, which is really a smart move. And, I keep telling people don't get the slippage in the larger equities that you get in the retail market because of these large spreads between bid and ask when you're dealing in physical metals.
What about platinum? Platinum's
Well, I
been
just
making some
bought
big
some
moves too.
more, so I put my money where my mouth is. I got in around the $1,600 level. Did I wait for my rule? Kind of. If you go down, it's kind of hard to draw a horizontal there, Danny, but it'd be kind of in that consolidation phase. And then we see a long green line. So I was
Mm,
kind of betting my own stuff, but
like
I
this.
don't always follow. Yeah, right there. I don't always follow my own rule. I mean, I just sensed that 1,600 was low enough and it consolidated there for long enough. And I know the fundamentals, so I use both fundamentals and technical. And I said, well, I'm going to average up because my average price until this last purchase was roughly the $1,000 per ounce level. So adding at 1,600 brought my average price up to like 1,200 or something like that.
Mhm.
So even if I lost on this last trade, if you combine this last trade with all the trades I've made before now, I'm still, well in the profit zone. That's the beauty of averaging up. You're already adding to a profit you have. And yeah, your average price is going up, but you are still in the profit zone. Whereas if you average down, you could go broke. I mean, there's people that average down and think, oh, I'm getting a lower price, a lower price. Well, then when that stock goes to zero, you're out of money.
So, what about the broader landscape though? The fact that you're seeing the 10-year yield spike above 4.6% consistently now, they haven't been able to bring it down, or it hasn't come down for weeks now below 4.6%. That used to be the no-go zone about, a month or so ago. Now it's the only zone we're in. What is this telling us? You also have the stuff that's going on in Korea and South Korea with their stock market weakness. They lost 40% of value on their Kospi index for over 40 days. Today, right now, it is in a recovery. You call it that. Pull up the Kospi here. You had a big plunge down 40% in the Kospi from the top to the bottom. There is a bit of a recovery ongoing now, but you're still giving up quite a ton. You're still down a whopping 32% from the highs. You have the stuff that's going on in Japan with the Japanese yen having to be bailed out by the US Treasury. Is there something cooking beneath the surface?
Well, the really most important question you've asked so far, and you've asked some really good ones. But now the big picture is what we have to focus on, and that's the debt market or the credit markets. And the market's telling us, not David, that things are breaking, not broken, breaking. In other words, the 4.6, as you mentioned, is significant relative to where it's been in the past. And this near term data is the most important data because it's now. And that's saying right now, we're not trusting things as they stand. So, whatever the Fed does with interest rates in this next go around may or may not help the yield curve because the market's starting to do what it did in the 70s when I was, your age or younger. And we would see, what the money supply was and the bond, we call them bond vigilantes. The
Mhm.
bond market would really take care of business. And that's why Volcker really came in and kind of saved the day because he made the dollar very sound again and blew up the gold market. But this time around, we don't have the same debt to GDP ratio that we had back then. We can't really work our ways out of it this time, at least not very easily. It seems impossible mathematically. So, those are very important questions. It's kind of like at a breakout, like we're showing on the silver, gold, and GDX charts, that the yields are telling us something is not right and something could go awry. And I don't think the breakdown will be a bank closure over a long weekend and you wake up and your banks are closed. I really don't see that happening. Could it? Of course. Will it? I doubt it. But will happen is this financial repression where the Fed really tries to manage the yield curve where you're getting repressed on your true returns. So you're getting 4.6%, but real inflation is at 6.6%. So you're losing 2% a year by keeping your money into the T bond arena. And that's the way that these governments pay off debt, by cheap dollars. They continue to debase the currency. The currency markets keep getting taken because they're not getting a yield commensurate with the true cost of living. And therefore, they keep cheapening the dollar to pay off the holders of the bonds. That won't go on forever. As I've said many times, I do see a financial reset of some sort, probably something along the lines of a tokenized financial system based on digits only and a whole new way of doing business as far as a cashless type of society. I mean, most transactions are digital now anyway. So that part of it's already in place and has been for decades. What's going to change is your ability to use cash and your ability to have any anonymity whatsoever, and that the money is going to be programmable.
Well, they're going to need a ton of commodities to build out the data centers necessary to power this surveillance grid and this AI data center build out in general. Does this imply that commodities are ready to run? Is the real smart money allocating its capital into the commodity space as opposed to the, let's call it the tech space, the AI growth space? Is that where you see um, smart capital running to?
Absolutely. I mean, I'm not a big guy in cycle theory. There used to be a guy who lost contact with him, was very good on cycle analysis. And there are some out there still that are good at it, better than I am. But one of the main cycles is between paper assets and real assets. And in a broad brush stroke, that's between the stock market and the commodity sector. And that's exactly what you described and exactly what's taking place. Now, it's slow to begin. When the change takes place, there's only a few that swap out of, let's say, you know, the S&P 500 and move into Goldman Sachs Commodity Index, for example. But there's someone that does that. And then there's another and another and another. And all of a sudden the stock market starts down and people start hedging and blah, 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 blah. So that change has started. And I think it will continue. And that's why I'm pretty convinced we haven't seen the top in either of the metals yet. Because for me to be convinced that we've hit the high in the metals, we have to see a low or relatively inflation adjusted low in the S&P 500, the Dow Jones, those indexes, because
So,
they are
it,
usually negatively correlated. There's times when they are correlated, but most of the time, in the long-term view, the most negatively correlated asset to the Dow Jones or the S&P is gold.
so if you look at the Thomson Reuters commodity index, I'm just picking that out of randomness. I mean, you could
Sure.
use any CRB, you could use any commodity index you'd like, and you look at that index relative to the Nasdaq, and you get a chart something like this. You'll probably get a similar chart if you look at the Bloomberg Commodity Index or the Goldman Sachs Commodity Index. But for the sake of argument here, you'll notice a 40 plus year bear market in commodities relative to tech.
Correct.
However,
Yep.
you kind of have this. Is this a double bottom here? Bottom here?
Looks like a double bottom, and thanks.
Yeah.
You're really good at bringing this stuff up. I love this StreamYard. You can do this kind of stuff. Yeah, I would say the first one there on the left is a false breakout. We bottomed, and look at
Mhm.
all those greens in a row, and those are significant. I don't know what the volumes are.
Yep.
The volume isn't showing, but that would have convinced me, and it would have made my rule. Now, if you use my rule, you follow it up with a stop. So you would have got stopped out, wouldn't have gotten the peak. unless you decided on your own, hey, that's high enough. And then it's already come all the way back down. But it did go up. Look at that green line to the right there, not the last one, but the one pre that one. I mean, that's again significant. It kind of matches the one on the left when it broke out, which is kind of interesting because if
Mm.
you know how to look, some of these things do get kind of
Well, that
symmetrical.
was March. That was March of this year. This is when oil spiked to like 120.
Yeah, and you see it gapped up too.
Hmm.
So, I think it's an opportunity is what I think. And I do think that the trend has already started. You might call it a false start. I mean, I don't want to be, making myself sound right. I mean, the market knows, but I think we're going to see that trend manifest itself where it's clear for everyone to see probably within a year.
There does appear to be uh, some a good amount of trading happening in this area, though. Like this area here that we're in,
Yeah.
kind of acting as some sort of potentially some sort of resistance. There's some trading that happens in this area right
Mhm.
above the top line, but not as much. So maybe you could say, once maybe this is the level to watch.
I would.
The
That's
above.
about where I would draw it. It looks a little high, but if you look at your bottom line there, and I was trading this with a big backup, that would be my buying zone. I'd leave
Mm,
it alone in between the two lines. When it broke out, I'd probably add a little bit and let her run. If it broke the bottom, then I'd be losing a lot, But
mm.
that bottom is a double bottom. I'm, looking at this today. Someone's going to say, "Well, you're wrong," or maybe I'll be wrong. I don't know. But but knowing who I know, and what they're doing, and some of these family offices, et cetera. It's not a lot of them, but as I said earlier, it starts with one, and then a couple, then a couple more, then a few more, and what's the best evidence that we have that everybody's familiar with? Central bank buying of gold. I
Mhm.
mean, that's been going on for a few years now, and they continue to buy even at gold, 2,500, and then 3,500, and now 40, not quite 4,500. They just continue to accumulate. And China is not in as great a shape. I mean, as some sectors they're fine, and others are not. They're very quiet with what's going on in the Gulf, and then they're printing again, and that's kind of the production engine of the world these days. Is what's produced comes from China most of the time.
What's the current status of the petrodollar, given everything that's transpired since March with the Strait of Hormuz and everything else? Is the petrodollar has the petrodollar weakened, or is the fact that I mean OPEC has been pretty much destroyed the last several months? It's made the U.S. a huge exporter of oil. Um, so you can make the argument both ways. But how do you see the current makeup?
Well, I'm confused. I made my whole editorial about it, and I just finished writing that a week ago, and I'm confused. So I won't give you any advice or any thoughts because I'm not sure. It's not acting the way you would expect. I mean, expect with all of this closure and everything that it should go higher, as you showed it did for a while in that chart we just looked at with that big spike up. But then it's fallen off. I mean, my final paragraph in the editorial was, there is pent up oil supply sitting in Iran in, big containers that could be used to suppress the price. I mean, you've got a big flood of whatever it is, cotton, cocoa, and it's being held off the market for whatever reason. And then all of a sudden it's all available and you shoot all that availability onto the futures exchange. It's going to take the price down, not up. So I made that point, but I can't offer anything. I'm confused about it. It doesn't make any sense. It seems if we really have what we're told, that oil would be drifting, bumping up against, the recent highs and continue to gain strength, and it's not.
Hmm.
What
Well,
what do you think? I mean, you said it too. I mean, I'd offer more if I had it. I just don't want to confuse people because I'm
yeah, yeah.
confused.
No,
I don't get it.
no. I mean, it seems like we are heading to a bifurcation of the Western and the Eastern hemispheres. this is probably why, in my opinion, this is probably why Trump has been making such a big play for Canada, Greenland, South America, et cetera, because of the Eastern Hemisphere is slowly but surely trending away from the United States. The Strait of Hormuz stuff that's happened the last several months is a key indication. I'm sure you took out OPEC, but I mean, we're not allowed to transit the strait any longer as a result.
Yeah.
So we've lost contact with that side, even more so. So it's, in my opinion, it just seems like more and more of a bifurcation of East and West. It seems like we are potentially retreating to our Western hemisphere, and that could be a good thing, right? You build out Fortress America here and focus on our side of town, as opposed to trying to be proactive across the globe.
Exactly. I mean, I did an interview a couple of days ago, and how much silver we mined in the United States when the Silver Liberty Eagle program was founded and put into law, and we were supposed to manufacture silver coins for whoever wanted to buy them. It was based on domestic supply only. Well, after the supply ran out of the above ground stockpile, and we had to get it from mining activity in the United States, we didn't mine enough within the United States to keep the Silver Eagle program going. That shows you how pathetically small the U.S. mining industry is within the United States. There's many U.S. miners that have holdings in South America and other locations, Canada and other places. So the conglomerate owns things outside of the U.S. That's not what I'm saying. What I'm saying is domestically produced within the land mass of the United States didn't produce enough silver to keep the Eagle program going. And in those days, that was like 30 million ounces a year.
Did you also hear what Trump announced recently, a couple of days ago, about $100 million allocated to trade schools and universities to train American miners? So,
well, I don't think it's a little too late, but it certainly is. It's enough. And is it in time? I would ask that question. I mean, you can only press the, pedal to the metal force and force it. I mean, if you're in an automobile, you slam it, you're going to go faster. But if it's putting mining activity into place, boy, that's a long-term process.
Mm-hmm.
Even if you get rid of a lot of red tape and expedite, all of this because of national security, and all those things are probably valid. It's not a turnkey kind of a deal. It takes a while to put a mine in, and anyway, I don't know. I'm not real optimistic. I think it's a good thing. I think it's needed. I think it's a little late. Or more than a little late. It's very late.
Mm. Well, anything else you want to talk about, David, before we wrap up?
Yeah, I just want to reiterate a couple things. So I would say that gold could decline during periods of inflation if real yields are rising and the confidence in policymakers remains intact. So what we talked about, the treasury market, and if that market starts to take off and yields go higher, people, oh my goodness, but it's really to protect the dollar, and it could take away from some gold buying. Central banks remain the foundation of the gold market. I mean, they continue to buy, as I said earlier. I'd say silver's in recovery, but hasn't returned to a mania, even though we're getting some of my peer group that seem to be pointing out that they expect higher prices than I do by the end of the year. My interpretation is the January spike demonstrated what happens when investment demand collides with comparatively small market. A subsequent collapse removed leverage by a great deal. Weekends and excessive expectations were taken to the cleaners. And the recovery into the mid-60s suggests that buyers are returning, but this is not yet the proof of another immediate parabolic move. Silver has probably completed the punishment phase, but does not mean it's eliminated the volatility. Gold-silver ratio we already went through. Silver's two engines remain the same: monetary and investment demand, coupled with industrial demand that's not going away. There's too much sensationalism around COMEX inventories. I've been through that so many times. Physical metals versus ETFs. We talked about that. why it's good to have a balance between a physical metal that you own as an investor or speculator or hedger and what you can do in the ETFs or the underlying mining equities.
Well, here's a question for that, Dave, really quick, if you don't mind me interrupting.
Sure.
Do the mining stocks, are they dependent on a breakout in gold and silver right now, or
Not at
can
all.
they? Okay.
Not at all. They are dependent on what their earnings are, and the margins are so high in most of the gold and silver miners that even with, let's say, a flat gold and silver market, the margins are still very, very high, and the stock price has not met what the true margins are. In other words, what their profits or their free cash flow. Mining stocks use it free cash flow better than any other indicator. So the free cash flows are so strong in both, generally speaking, the miners, gold and silver, that stock price is undervalued relative to what the cash is throwing off.
And
And so they don't need a higher price. In fact, if it went sideways, it'd probably help the miners even more. And you showed that breakout with your chart on those gaps and the amount of volume. You don't get those kind of gaps if it isn't significant buying pressure at a higher price and no one else, the offer, there's only a little bit of offer there. I'll sell mine at this price. I'll take it, and gobbles it up. So again, we got some pretty strong momentum. Will it carry through or not? I don't know, but it certainly looks that way.
Yeah, because this is what I've been going back and forth on, is whether or not the mining stocks are giving an early warning indication of the future breakout of gold and silver. But it could also be possible that they're just playing catch up. They're given their all-in sustaining costs for a lot of these mining stocks. I mean, they're profitable at even sub $2,000 level gold, and from that point.
$6 silver. I mean,
Yeah.
the worst silver miner that's really in production is probably mine at $32 the ounce, all in sustaining costs and taxes. But no, I agree with you. I lean toward the higher probability. In a real strong bull market, the shares actually lead. Now we've been taught, by others they don't, and they don't always, but generally they do. The preponderance of data will show you that the strong bull markets, not in bear markets, the metals mining equities actually lead. Not always, but usually. So could it be, as you said, I'll agree exactly with what you said, Danny. I don't know. It's perplexed. Is it leading, or is it just the fact that even with the sideways market, these things are good investments?
Right. Well, Dave, it's always a pleasure, my friend. We'll get to the bottom of this, and we'll keep
Okay.
monitoring the situation. Yeah, we'll have you on again here shortly. Anything else you'd like to plug before we sign off?
Just maybe a little more feedback on my documentary came out October last year, the silversunrise.tv. I keep the comments open on that for people that want to comment. I read them. I doubt I'm doing another film. I doubt I'm doing another book. I doubt I'm doing another $100 silver party, but I'm always learning more, and I'm trying to be of maximum service to others that are willing to keep an open mind and realize the monetary system is crucial to our financial well-being, but there's a lot more to life than money. So I always try to keep it balanced.
All right, very good. Well, thank you so much for your time. As always, David, we will have your links in the description box below, so everyone go check it out. Like the video, subscribe to the channel, hype the video if you're watching on mobile or tablet. If you want to support the channel monetarily, I do have a buy me a coffee link in the description box and pinned comment down below. We also have affiliate links for our great affiliates. You can support me that way, and you get a great product in return. And support me on Substack too, if you'd like, or just become a free member. It's capitalcosm.substack.com. Get all my stuff early, ad free, and we'll be rolling out some new features on Substack too. So you want to be in tune with that. So with all that said, I appreciate your time, everyone. We'll catch you all next time. Let me know your thoughts. Are we breaking out? Are we not breaking out? Is it a fake out? Let me know your thoughts, and let me know what evidence you're using for your rationale. So let's just leave it at that. I'll catch you later.